Ladies and gentlemen, welcome to another very exciting episode of Beginner Series in Crypto Trading. Today we'll be looking at the fourth part, which is risk management in crypto trading. Risk management is very important to any endeavor that you are taking. Whether you are trading crypto, whether you're trading equities, whether you're trading commodities or ETFs, it's very important to have risk mitigation and management measures in place to ensure that above all, you can protect your capital. In today's episode, we'll be looking at the use of leverage, how you're supposed to enter the market, key things that you're supposed to check before you enter any market, how you are supposed to set your stop losses, as well as distribution and the redistribution of your capital after you have made a trade. Welcome and let's work together in this episode. My screens are set, and when it comes to risk management, any form of trading, the first thing that you need to know is in as much as you want to make a profit from the trade that you're running, somebody else also wants to make a profit. Somebody has to lose for you to win, or an asset has to go up in value for you to gain. So those two things determine whether you're going to make a profit or not. And that's the reason you see we have so many liquidations because some people take a certain position in the market while others take the different position in the market. So that said, the first point, as I have put it here, it is very important for you. It is very important for you. I had forgotten that I'm using the extended screen. I can only write on my laptop. The laptop is the one that allows me to write. So in this regard, probably on this level, I'll be writing or highlighting. Yes, I'll be highlighting. That's highlighting. So as you know, it's very important for you to understand that you only need to trade what you can afford to lose. If the only money that you have is money for you to pay rent, is money for you to buy food, is money for you to survive after getting laid off from work, then do not put it in any form of exchange trading. You are going to lose, most likely. Because first, you're going to trade under pressure. Secondly, you'll have unrealistic expectations to make profit. And third, you'll be impatient. So those are the three biggest killers if you have anxiety issues to make profits. So only trade what you can afford to lose. If you find that the amount of capital you are putting on any trade, you cannot stomach any losing, then do not trade. Look for another form of investment that you can put your money to get a profit. Do not put it in trading. So you need to set very clear expectations within yourself so that in this trade that I'm entering, I can make it or I can fail to make it. So that's the first rule. Secondly, is the use of leverage. Leverage is a killer. Leverage can be very good for you or it can be very bad for you, depending on how you structure your leverage. If you are starting out and you do not have enough capital, leverage is going to be very important to boost the amount of profit that you can make. So that is when you need a leverage. But if you have excess or enough capital, then chances are sometimes you do not need a leverage at all. So if you can get to a point of entering the market without the need of leverage, then you are at the right time. You are the right. You'll be doing the right thing. As a matter of fact, you should trade and have a goal at the end of everything you when you make it in trading to be entering trades without leverage. There are times you can have enough capital so that do not need leverage. Even if you make 5% profit every single week, you can compound that profit and it becomes a very big um, gain at the end of the year when you trade without leverage. Now, let's say you enter a position. The reason why this is Bybit and I've pushed, I've cascaded this window because I'm on an active trade. But I guess starting from next week, I'll be showing you on my live trade now. I didn't want to do this trade anyway. I wanted to wait until the sixth episode when we'll be doing live trading so that you can see me enter trades. Anyway, uh, let's say you enter I'm already on a long position right now as we speak. So let's say you enter a long position at 16.4. There's no guarantee that this price is going to come to 16.8 immediately. But before the end of the week, it will definitely be at 16.8. That is guaranteed. So the price can take a nosedive and start going down. So if the price is going down to 15.8 or 15.6 and you have used excess leverage, you are going to get liquidated. You're going to lose every capital that you have. But if you decide to trade without capital, without leverage, even if the price takes some tumble going downwards, that will be less of your worries. Because at the end of the day, the price will come back to its normal position of your entry, which is 16.4, or even up higher than your entry, which can be 16.8, 17, or 17.2. Because this is the range that the price will be moving this week. This week, the price will be rotating between 15.6 to 17.2, according to me. So, this is what I think. This is what my analysis show. So, even if you had a bad entry by bad luck, and then the price continue to go down a little bit to 15.8, you will not be worried if you didn't trade with leverage. You'll just wait until the price comes back to 16.4 or even higher 17 or 17.2 and detect that profit. So avoid use of excess leverage. As for me, because you can see here, I'm using a leverage of 7x. This is the leverage that I usually find very much comfortable with me. But when I was starting to trade, I once tried 25x. Well, I won 1, 2, then I got liquidated. Then I also settled on 12.5x, gave me some mixed results, but I finally settled on 7x. I don't like 5x. I'm not a beginner. I find 5x being a little bit later because when I trade, I always focus on getting 10 to 20% profit every single week consistently. And three I take profit in three bits: 10%, 20%, and 30%. So 10 plus 20 plus 30, that is 60 divided by 3, 20. So I consistently make 20% profit off the capital that I'm trading with when I use 7x leverage. But if I use 5x leverage, I'll be looking at around 14, 15%. I don't want 14, 15, I want at least 20% profit every single week. So with 7x, I'm very much comfortable. If you are starting to trade, you can just use 2.5x to 5x until you become good. Then you can push your leverage a little bit high. The third most important thing on risk management is keep off trading when time frames have a split red RSI. Let me tell you what I mean. So right here, when you look at the 15 minutes chart, the RSI here was green and then it has just turned red. I don't have a problem with that. But now when you look at the higher time frames, let's look at the 45 minutes time frame. So the 45 minutes time frame here, the RSI is green. So right now I'm trading on the 45-minute time frame. So it means at around 15.6 or 16.6, I'll be looking at an exit position for the market because the market is not going to pump higher than that. Why? Because the 2-hour time frame has a split red RSI. So if there was a split red RSI on the 2-hour mark, and at the same time we have a split red RSI on the 4-hour mark, I would not enter any long position. The reason why I've entered a long position right now is because I'm protected by the 4-hour because we have green RSI, even though the 2-hour RSI is red. So that means I've entered the market with the 45-minute RSI, which is green at this point. So at around 16.5, 16.6, and 16.7, I'll be looking at an exit of this long position. So when you get to a point where you find that you have split red RSIs, split red RSIs will always be everywhere. Like here, this is a split red RSI. This is what I'm talking about. So when you find that we have different time frames, two time frames that have consecutive split red RSI, like you find the 2 hour RSI is split red and the 4 RSI is split red, keep off any trading position because most likely you are going to lose. That's understood. We have already talked about that. The fourth thing, understand that long starts when the 4 hour confirms. So what I mean by that is looking at this 4 hour chart. So when you look at this 4 hour chart, I'm waiting for a confirmation of the long position here for me to long the market. But I have the experience for me to enter the market even before the 4 hour confirms. So if you are starting, do not enter the market before the 4 hour confirms. The reason why I've entered the market here before the 4 hours confirmed because of this yellow wave. I usually call them yellow trigger wave. When you look, this one look like this is a very sharp trigger wave that is facing up. And this is showing me that we are going to have a very strong reversal. There's a very strong reversal happening at this point, whereby the bulls are taking control over the market and the bears are losing momentum because of this very sharp yellow trigger wave. So this is the reason why I've entered the market even 22 minutes before the 4 hour has confirmed. So if you are starting to trade, always wait until the 4 hour confirm. By the time the 4 hour confirm, this price can be 16,400 or 16,300. There's no problem with that because still even at 16,300 or 16,400, you're going to make profit before we are done with the pump that is happening, that's about to happen right now. So if you're starting, always wait for the 4 hour to confirm. And if 4 hour confirms, chances of you losing are going to be very low. I'm telling you this from experience because I've tried everything and I want just to make your learning experience to be a little bit smoother and better. And I'm just the most important thing I want right now is to protect your capital. The fifth thing, use dollar cost average for entry. So my capital is somewhere here. So let's say I have $1,000 that I want to trade with. So what will happen is when I'm entering the market here, I will enter a long position. I long the market at 16,200 with $250. Then I wait for the 4 hour to confirm. Then I wait for this 20 minutes to close. Let's say the price has moved to 16,300. Then I'll enter another quarter position with $250 at 16,300. Remember the first one I entered at 16,200. The second one now I've entered at 16,300. Average, I will have entered the market with 16,250. Then I'll wait for something different. I'll wait now maybe for 8 hours to confirm. I'll enter the market with another quarter. Let's say at that time it will be 16.4. That will push the price to be around 16.3, the average. And then probably I will enter the final part somewhere in between. Even if now this price decides to drop a little bit from 16.2 to either 16.1 or 16, I'll enter with another quarter. So I will enter the market on 4 quarters. And at the end of the 8 hour period of entering the market, you'll find that there is an average that I've entered the market with. In that way, I'm protected when the price goes a little bit lower, and I will not have missed the market if the price does a quick spike upward. Hope you understand that point. Very important. Number six, always set your stop losses. My stop losses are usually 500 from the entry. So I entered the market here at 16,100. So at 16,100 less 500, that is 15, 15,600. So if this price decides to go lower to 15,600, I will automatically exit the market and take that loss. So you need to have a stop loss somewhere, either already running in your trade or somewhere in your mind, knowing that if the price decides to fluctuate downwards to that level, you exit the market. Because there's no guarantee that if it fluctuates downwards by 500, that we are going to have a reversal. It can still keep plunging downwards. And the most important thing is not to make a profit. The most important thing is to protect your capital. There will be so many opportunities to long the market all the time. So, most importantly, protect the capital that you have. If you can learn the art of defense, an opportunity for offense will always come. Opportunity to attack the market in a long position and make a profit will always come, either once or twice in a week. That is a guarantee. Even if we are in the deep part of the bear market, there will be always an opportunity for a bounce back. So protect your capital and wait for those opportunities to be presented to you, and then take those opportunities. So put a stop loss somewhere psychologically or physically in a trade. I myself, I put the stop loss physically in a trade by negative 500 basis points. Take profit at intervals. So in this trade, I'll be taking profit at intervals of 400. So if I've entered the market at 16,100, I'll take the first profit at 16,4, the second at 16,9, and the third one at 17,3. So at 17,3, I will have totally exited the market at 17,3. So I'll take three profits of about 10, 11 or 12%. The other one will be 20 to 24%, and the last one will be 30 to 36%. So at the end, and then whether I decide to take 10% or 12% will be determined by how big, sorry, will be determined by how big the blue wave is. There's a blue wave here that is about to form, which is a momentum wave. The depth and the size. So this is the depth of the blue wave from 0 to negative 90. So that is a good depth. So the depth of the blue wave is the one that is going to determine whether I'm going to take 10 or 12%, according to me. So if this blue wave was just at 50, I will not even take 400, 400, 400. Let's just take 250, 250, 250, 750, and then I exit the market. That would mean maybe I'll make less than 20, but somewhere close to 17%. I'm very much comfortable with that because that is the pump that we will be having that week. So depending with the deeper the blue wave and the deeper the blue wave momentum, that is this cloud, the bigger the pump is going to be for that week. So I understand that. So do not wait for the price to move all the way up to 17,600 or 17,200 for you to take a profit. There will be surprise reversals. So always lock your profits. 10% lock, 20 lock, 30 lock and exit the market. And then wait for all reversals to happen. You'll have already made your money. The last thing is keep some capital off the trading platform that we're using. What you need to understand is like the recent saga of FTX, people who are trading with the FTX platform lost their money. Investors lost their money because everything was in the FTX platform. So when you have a successful trade and you make money, ensure that you can keep some profit off the exchange. Also keep some capital off the exchange. So let's say I'm trading with $1,000, and then at the end of the day I make $200 on top, so I have like $1,200. So I'll determine what I want to do next. So let's say next time I also want to enter with $1,000 as well. So I'll now take this $200 profit and then I put it off the exchange. I can put it in a local bank, in my credit card, or in whichever place. Or I can use it to buy some real estate or another investment. So that even if there is a deep crisis in the crypto market and the exchange, in one way or the other, cannot permit any withdrawal of funds that you're having, or it has been liquidated or for whatever reason, you are not going to start from zero. You have some capital somewhere. I've learned this through a very painful lesson. Um, from even the recent FTX saga, I was a victim of some funds that I lost, and I lost a big chunk of money. So, so this eighth point is a point that I've put from the experience that I just experienced a month ago. Actually, it's this month, the start of this month. So ensure that you have some capital that is off the exchange at the end of a trade, so that even if anything bad happens, you have some soft landing to give yourself an edge to trade again in future. So those are eight very important risk management techniques that you need to put in place. And if you put in place, your chances of having very doomsday and things going totally against you are going to be really low and eliminated. So thank you so much for listening to me. Thank you so much for this episode. I will be looking at the fifth episode, which is coming, which is trading psychology. That is the last theoretical part that we want to look at. Before now, we can get to the live crypto trading. Because I know most of you are very much excited to see the live crypto trading, but it would have been of no use to go straight to the live crypto trading before I can give you the mitigations and these important tips so that I can prepare you now to become a good trader. So we have one more episode, that is episode 5, dropping on the trading psychology and the bull and bear traps, how they happen, and the fluctuations, and how you're supposed to set yourself mentally so that you do not get carried away by those swings. And then now on the 6th, we'll be looking at live to crypto trading. Then on the 7th one, we'll be looking at how to uh, how to protect your capital. And I think after that, I'll also be dropping another episode on everything that you need to know about trading bots. When you hear people saying that they want to sell you bots, are they scams or not? Most likely they are going to be scams. So I'll be telling you about trading bots, where you can get trading bots if you want a trading bot, and this is how the chances of success of the trading bot will be. And I'll also be telling you whether I use a bot or not. I do not, but personally, I don't use a bot because I'm a bot myself. I have my own algorithms that I've set. So I'll be also be talking about bots at the end of the seventh episode. So stay tuned. Thank you so much for your time. Ensure that you these eight risk management techniques that we've said, you put them into use, and your chances of success are going to be enhanced. And see you on the fifth episode that is dropping later this week. Yeah, it should be. So thank you so much.